Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, our weekly podcast that sums up market movements and events over the past week and its implication on asset markets. I'm Vinay Joseph, the host for this week's podcast. Now, last week, Indian markets succumbed to selling pressure from investors as risk sentiments soared amid mounting risks to economic growth and corporate earnings from the new US tariffs. The benchmark Nifty 50 index fell by 1.8% for the week, its worst weekly loss since early April of this year. The broader market saw a deeper correction, with the mid-cap and small-cap indices falling 3.4% and 3.8% respectively. Among sectors, banks, realty, utilities and metals saw cuts of over 3% for the week, while IT and FMCG were the only sectors to end in the green. The rupee closed at an all-time record high of 88.21 versus the US dollar, down 1.5% for the week, as the 50% US trade tariff took effect this week. Now, FIIs continued to be sellers and they have sold over $4 billion of equities in August alone, taking their 2025 YTD outflows to over $12 billion. Now, looking at bonds, the benchmark 10-year bond yield jumped as much as 11 basis points on Friday to 6.64% before trimming gains on the back of stronger than expected data for the June quarter growth, which tempered hopes of a central bank rate cut. Overall, for the week, the 10-year government bond closed 6 bips higher to 6.57%. Now, the key macro data point came out towards the end of the week, which was the Q1 fiscal year 2026 growth data, and this came much higher than expectations. Q1 growth of 7.8% year-on-year was stronger than consensus expectations of 6.7%. In fact, Q1 GDP growth was the strongest since Q1 fiscal year 2024, dispelling concerns about a sharp slowdown in economic activity as we went into the tariff tantrum. Now, Q1 growth buoyancy was actually mostly driven by lower deflator due to subdued inflation, with nominal GDP growth for the quarter only at 8.8% versus 10.8% the previous quarter. The stronger than expected Q1 GDP is likely to drive upgrades to full year estimates of growth for fiscal year 2026. However, the outlook for growth is clouded with uncertainty from the continued elevated tariffs and the related risks that emanate from them. From corporates' ability to absorb these shocks, with the possibility of significant job losses in labor-intensive sector and its indirect impact on service sector growth. The increasing risk to growth, which consensus estimates suggest around 0.7% to 1% of GDP growth, warrants some focused policy support. Now, the income tax cut in the budget and the recent GST rate rationalization could partially help offset the impact amid tailwinds from a good monsoon season. But with most monetary support provided already in this cycle, growth and corporate earnings could remain under pressure in the H2 or the second half of fiscal year 2026, thus dampening risk sentiments. Within a diversified allocation, we remain overweight equities but preferred a more diversified equity exposure and look at multi-asset strategy to withstand this near-term volatility. That's all for this week. Thank you for listening to our podcast, and if you find it useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.